When you hear the name Warren Buffett, you probably think of the Oracle of Omaha, right? The legendary billionaire investor. But before all that, he was just a 25-year-old from Nebraska with a pretty radical idea about how to invest. Today, we're cracking open his original playbook to see the simple but powerful principles that started it all. And listen to this claim Buffett made decades later. 50% a year. That sounds completely audacious, but it actually points back to a time when he was younger, hungrier, and working with way smaller sums of money. This is the Buffett we're digging into today. The one who was dead certain he could crush the market, all because he had a secret set of rules. So here's how we're going to break down his playbook. First, we'll meet the man before he became a myth. Then we'll dive into his non-negotiable ground rules. We'll look at his psychological edge with Mr. Market, see how he used the magic of compounding, learn his unique way of keeping score, and finally, get to the ultimate paradox of his genius. All right, let's go back in time. It's 1956. A 25-year-old Warren Buffett is back home in Omaha. He just finished working for his hero, the legendary Benjamin Graham in New York. But he doesn't have a big fancy office or a huge team. Nope, he's got about $100,000 to his name and an idea to start an investment partnership with just a few family members and friends. This is ground zero. So Buffett gets his first 7 potential investors together at the Omaha Club for a little meeting. But here's the thing. He doesn't pitch them a single hot stock. He doesn't promise them they'll get rich quick. Instead, he hands them a document called the Ground Rules. And his message was basically, look, if you agree with these rules, great, let's invest together. If not, no problem, no hard feeling.
And these rules were the heart of it all. First, he said success isn't just about making money, it's about beating the market. Second, he told them, you got to be patient, judge me over 3 to 5 years, not 1. Third, he made it clear he wasn't a fortune teller. Predicting the market is a fool's game. And maybe most important of all, he put his own skin in the game. He invested pretty much his entire net worth right alongside them. This wasn't a sales pitch, it was a pact.
So, you might be wondering, how could he make those promises with such confidence? Well, to get that, you have to understand this core idea he learned from his teacher, Benjamin Graham. It's a way of thinking that puts a huge wall between real investing and what most people do, which is basically just speculating. Graham came up with this brilliant analogy. He said to imagine the stock market as your business partner, and his name is Mr. Market. The thing is, Mr. Market is a total mess. Some days he's euphoric, offering to buy your shares for way more than they're worth. Other days, he's in a full-blown panic, trying to sell you his shares for pennies on the dollar. Buffett's genius was realizing you can just ignore him. Mr. Market is there to serve you, not to tell you what to do. You take advantage of his crazy mood swings, you don't catch them. And that brings us to the most important distinction of all. An investor, the way Buffett sees it, asks, what is this actual business worth? They're focused on how the company will do over years. A speculator, on the other hand, just asks, where's the stock price going tomorrow? They're just betting on Mr. Market's wild, unpredictable moods.
And this famous line from Graham just nails it. In the short run, the market is just a popularity contest, a voting machine. But if you wait long enough, it becomes a weighing machine, where the true underlying value of a business, its actual substance, is what really matters.
This whole long-term view is fueled by what Buffett saw as the real engine of wealth creation. It's a force so powerful, Einstein supposedly called it the 8th wonder of the world, compound interest. For Buffett, getting this concept was everything. Buffett would actually show tables just like this one to his partners to explain the magic, and just look at the difference. If you take $100,000 and grow it at 4% for 30 years, you get about $224,000. Pretty good, but at 16%, it explodes to nearly $8.5 million. Those little differences in your yearly return don't just add up over time, they multiply into these absolutely mind-boggling numbers. This curve shows you exactly why patience is the secret ingredient. You see, for the first few years, it looks kind of boring, right? The growth is slow, almost flat, but then it hits that elbow in the curve. The real, explosive, off-the-charts growth happens in the later years. All you need is a decent rate of return and, crucially, a long runway of time. To really hammer this point home, Buffett told this fantastic story. He figured that if Queen Isabella had taken the $30,000 she gave to Columbus and instead invested it at just 4%, that money would have grown to, wait for it, $2 trillion. It's almost hard to believe, but that's the power we're talking about.
So if compounding is the engine, how did Buffett actually know if he was winning? Well, he had a super simple and honestly kind of ruthless way of keeping score. It wasn't about whether he made money in any one year. It was all about whether his engine was running faster than everyone else's.
He used this perfect analogy. He said the stock market is like a duck pond. When the water level rises, that's a bull market. All the ducks, meaning all the investors, they just float up. And when the water level falls, they all go down. Buffett said he didn't care about the water level. He only cared about the behavior of his duck. Was his duck flapping its wings to rise even faster? Or was it swimming hard to sink slower than the rest? That's all that mattered.
And his scorecard was really specific. The goal, beat the Dow by an average of 10 percentage points a year. The time frame, at least 3 to 5 years, to smooth out all the random noise. And here's the kicker. He expected to do his best work, relatively speaking, when the market was tanking, because that's when his focus on real value would act as a cushion.
Okay, so we've just walked through the playbook of an absolute master, a guy who consistently beat the market for decades. But this brings us to the last and I think most surprising chapter. After a whole lifetime of proving he could win this game, what does the ultimate genius advise for the rest of us?
The answer is a total paradox. Despite his own legendary success with hands-on, active investing, Buffett's advice for almost everyone, including his own family, is to not even try to play his game.
And this right here is the knockout punch. This is literally from his own will, the instructions he left for the trust that will manage his wife's inheritance. And it couldn't be simpler. No complicated strategies, no clever stock picks. Just put 90% of the money in a basic, super low-cost S&P 500 index fund and just leave it alone. The greatest active investor in history is telling the people he loves most to be passive investors. And that leaves us with this one last, really provocative thought. Buffett's true secret wasn't a magic formula for picking stocks. It was his ironclad discipline, his emotional control, and his genuinely long-term vision. So maybe, just maybe, the ultimate act of discipline is recognizing just how hard his game is and having the wisdom not to play it at all.